Let's hone in on the so-called sell America trade. The dollar moving lower today, retreating from some of the positivity we saw earlier in the month. Our next guest is saying the recent run-up in the dollar was an opportunity to sell. Let's get into why with Jayati Bharadwaj, FX and macro strategist at TD Securities. Thank you so much for being here in studio. We really appreciate it. I know that you expect the dollar to fall by another 5% by the end of this year. To what extent do you see that as perhaps a cushion for stocks and kind of operationalize that relationship for me?
So what's interesting is actually that we've been hearing for the last 5 years the dollar is overvalued. In fact, for the last decade, the dollar is overvalued. But interestingly, the dollar's overvaluation has actually dovetailed with foreigners piling money into US assets, particularly US equities. For the longest time, people could just hold US equities unhedged because they would also get a very strong dollar rally to support their portfolio. Mm-hmm. But now that's not the case anymore. In fact, even if SPX might have tried to jump back to levels pre-Trump, but the dollar has not regained any of its strength. In fact, I think investors now have a very strong reason to hedge their long US asset exposure, and the dollar is no longer behaving like a safe haven, unfortunately. I would say it's actually following much more of an emerging market playbook, which is, I think, the unfortunate truth that we need to come to terms with.
And I think that's such a fascinating and important point. Do you see the United States behaving like an emerging market right now from an asset class perspective?
Absolutely, because when we are talking about this big, beautiful bill, it's actually also leading to a big deficit concern. We're not addressing the problem that Trump said he would start out to address. Mm-hmm. And that's actually feeding into risk premium into both the bond markets, which is why yields are higher. And there's also clearly risk premium in the FX markets, which is why the dollar is really struggling to rally here. In fact, the euro is now stepping up as the liquid alternative safe haven, as you mentioned, in equities because of attractive valuations, but also in FX because it is cheap, and it is now the other safe haven that people are now looking towards.
Now, I can hear investors getting nervous as you're speaking about the United States behaving like an emerging market. So let's put a finer point on this. Do you think that the current mix of policies has the U.S. behaving a certain way within markets, or are you suggesting that long-term U.S. Treasuries will be treated more like a credit rather than, its own asset class and a safe haven security?
I think that is the next biggest question that we are trying to answer for clients, that if we are talking about a big confidence shock, which you've seen, remnants of that, the way markets have been behaving, the volatility associated with current administration's policies is a big confidence shock, which is actually forcing other countries to step up their local fiscal policies, work on fostering stronger trade relationships amongst themselves. Europe and China are now talking to each other. It's also forcing other countries to think about self-sufficiency and cutting dependence on the US. The gap between the US and the rest of the world was extremely wide for the last few years, but now that gap is shrinking from both ends. US owing to its policies and the volatility around it, and now the rest of the world is being forced to introspect or do better on their own accord. Yeah. Now that gap is shrinking and there's more opportunities to diversify. Now, in terms of diversification, unfortunately, those kinds of moves take quarters, if not years, to play out. That's why we think that the next move lower in the dollar will not be as rapid as Q1, because Q1 was a very rapid positioning adjustment, but the next move will be structural, which will play out over the coming quarters. And that's why we think you could get another 5% move lower in the dollar by the end of the year.
Now, that sounds a bit more like a recalibration from a place where the U.S. was the only game in town to now there's other parts of the world that are going to benefit from this mix of policy. So back to it's a recalibration that is healthy, or is it an existential threat to the United States?
I think it's a healthy recalibration. Like, we've been doing so much digging into capital flows data, but it does seem that almost most of the money managers, pension funds, sovereign wealth funds, all the global savers of the world have actually been extremely overweight US assets, and that has actually ballooned since COVID. I actually think it's a healthy recalibration because for the longest time, everything, in fact, most markets became a pure US move and a pure dollar beta. But now you can actually start to focus on local idiosyncratic stories. You can focus on where are the valuations within emerging markets. Can Asia now rise up over Latin America? I think local interest stories will become interesting after a very long time again, which would actually make markets look elsewhere outside the US. I'm not saying the US will give up its crown position, but I would say maybe other prince and princesses start coming up on the shore and on the horizon.
Well, as we wrap up, Jayati, help our audience learn how to spot those princesses of the market coming up here. You talked about it a little bit, but what should the retail investor activity on this dynamic that you're describing look like?
I think the focus should now be on which countries have a lot of fiscal firepower to increase spending, local spending, and which countries also have a lot of power to repatriate flows locally back to their own domestic economies. I think that's where, to us, Europe, as Brian mentioned, and also Asia actually stands out. For the last 3 years, everyone has been long Latin America and short Asia because we were in the chase for the carry trade, we were chased for the US exposure, and we were also in the chase for the long commodity exposure after Russia-Ukraine. But now all of these three factors are not working. In fact, we're moving in the opposite direction, which is where all of the undervalued currencies in Asia and also in Europe can now start to see impressive performance, especially if the Fed starts to ease interest rates again towards the end of the year.